If everybody that owns silver is unwilling to sell it up until $30 an ounce, then somebody that goes in the coin shop and buys 2 coins is going to move the price. Now that's an extreme example, but I'm doing it as a thought experiment because that's basically how markets work. And this is where you get into these parabolic moves, because most people are taught incorrectly to buy low and sell high, and that does apply at times. But especially in the futures and commodities markets, you want to buy high and sell higher. Because when you have silver at, let's say, 30 and no one wants to sell until then, this is just a thought experiment. I know people are selling it today.
Brace yourself. The most monumental silver squeeze of all time has arrived. Welcome to a unique exploration of market dynamics with David Morgan. In this video, we challenge conventional wisdom, exploring why buying high to sell even higher is a strategy worth considering, especially in futures and commodities markets. Join us as we uncover the intriguing dynamics behind these parabolic moves and delve into the unconventional approach that could reshape how you view market behavior. Let's listen to David again.
Well, it's more nuanced than true or false, but if you look at Jeff's work, and I think it was a silver survey, I'm going to guess 5 years ago, he had a nice graphic in there. It showed that from recorded history, there's been 60 million ounces of silver that's been mined. And if you look at how much is above ground and available to the market, it's far less than that. So you can make that argument that there's been a deficit. If we mine that much, how come we don't have 60 million ounces? Now, the physicists will tell you it still exists because it's in a landfill, but it doesn't exist for practical purposes. I think the best way to look at the deficit is what's happening to the above ground stockpiles. So I don't think even Jeff can argue this one. If you look at the 1990 amount of investment grade silver above ground, it was 2 billion ounces. And we were in a deficit from 1990 to 2005. And for those 15 years, we actually ate up 100 million ounces on an annual basis average. So we got from 2 billion ounces to 500 million ounces. So we ate up 1.5 billion ounces. The only way you can, supply and demand always equals. So if you've got a deficit, then you take the above ground stockpile to fill in to make the balance. So you take the above ground stockpile to feed whatever the requirement is, be it investment demand or industrial demand or jewelry demand or silverware, for crying out loud. From 2005-06 until present day, the above ground stockpile of silver has been increasing. So from that perspective, we've seen an increase in above ground stockpiles. So are we in a deficit or are we not? And this is where it gets a bit nuanced, because the argument that we're still in a deficit is because the amount of demand is greater than the mine and recycled supply by a substantive amount last year, almost 200 million ounces. But where is that silver? And that's in investors' hands, basically. And I don't think anyone should have a problem with that concept. I always like to flip it over and ask the same thing about gold. I mean, the gold to silver ratio is 7-1 right now in the ground. The natural ratio back in the year 1300 is about 12-1. So we're certainly mining silver out at a rate that's depleting what the amount left is. So gold is, every ounce of gold is pretty much there. You know, I mean, it's either in jewelry or in a coin or in a bar. Some of it's been lost, but nothing like the silver market that really does consume part of it. So if you think the argument that silver is still building a stockpile invalidates it as a store of wealth, then you better look at the same question applied to gold. Because if you applied that to gold and say, well, gold's always increasing in supply. So what's the reason for holding it? And the last thing, and I know you're almost sick of me saying it done again, but all markets move at the margin. It's not how much gold's above ground or how much silver is above ground. It's what's the float. If everybody that owns silver is unwilling to sell it up until $30 an ounce, then somebody that goes in the coin shop and buys 2 coins is going to move the price. Now, that's an extreme example, but I'm doing it as a thought experiment because that's basically how markets work. And this is where you get into these parabolic moves, because most people are taught incorrectly to buy low and sell high, and that does apply at times. But especially in the futures and commodities markets, you want to buy high and sell higher. Because when you have silver at, let's say, 30 and no one wants to sell until then. This is just a thought experiment. I know people are selling it today, but they hold it. There's no supply. So the price has to be bid up to free some into the marketplace. Well, when you get a new high, what do? Psychologically, you hold on to it. You don't want to sell. Why? Because you're at a new high. You don't know how high it's going to go. So if it's at 30 and that's a new high, which it wouldn't be in the long-term chart, but let's say in the last 10 years or so, you're going to hold it. So that means in order for it to make a move and no one wants to sell, it's got to be bid higher to 33 or whatever. Do you really want to sell that precious metals for fiat? And that's a question that people may be asking themselves this time. I asked myself that question in 1980, and I said, I'm not so sure I want it. I want the paper. Wrong. The best thing you could have done in January 1980 was to sell your gold, buy the long-dated treasuries, long bond, get 17% interest, hold it for almost 40 years, which is the most major market in bonds ever, collected a coupon of 17%, and see the bond value increase. So I certainly will admit I was wrong in that instance. But that doesn't mean that this next time around, when we've got vastly more paper chasing a fixed supply of goods and services, that people really will want to exchange their metal for fiat. Now, what I think is going to happen, at least in some instances, is direct exchange. I will give you, 100 ounces for your used Chevy, or I'll give you 2,000 ounces for your barn, or, stuff like that. I don't want to go too deep. You get the idea, where you use the money directly for the exchange rather than using fiat as an intermediary. So the metal trumps the currency. And that has happened in the past. Yeah, that one Jeff and I disagree on. And, Jeff and I have known each other for 20 years. In fact, I had Jeff on a channel called the Free Market News Network way back before there was YouTube. That business failed. It just cost too much to get our own servers and stream video, because that's when video streaming was like brand new. No one knew how to do it. Anyway, I digress. So, if you read my book, The Silver Manifesto, I go through the Sharpe's ratio, why it's almost impossible to not show the markets manipulated. Gad has done great work showing that the London close and the New York open has a propensity to be a certain way, and that's impossible on a random walk. And then you have all these lawsuits where most of the parties haven't admitted guilt, but they paid these big fines because of spoofing the market. So I just disagree. Has it been suppressed every day? No, but it certainly has been managed for a very long time. I mean, this book behind me by Sutton, he talks about gold. And, I've done a mastermind series. I forget the gentleman's name. He's actually more or less in my neighborhood. He came to me at one of the conferences and showed me the gold chart. He says, this isn't a random walk. There's only one way you can get a chart like this, and that's with manipulation. I don't think he even used that word, but it's a fact. You can't go from a fixed price of 35 up to 42.22, and it's government says, no way we can raise the price of gold. We're admitting the dollar isn't doing well. So once they made that official change from a 35 an ounce to 42.22, it's never changed, because they want to make sure everybody's brainwashed with the propaganda press that a dollar is a dollar. But a dollar is 371.2 fine grains and 999 fine silver. And that definition has never changed. So were you paid dollars today? Probably not. Let me add on to that. I don't want to interrupt, but in the LA area at that same time frame, there aren't really any independent gas stations anymore. They're all owned by conglomerates. But in the day that you're referring to, there were some independent owners. And there was a couple in LA that had a line, like, these pumps are for silver only. So if you're paying in silver, that's your pump. Pay on demand.
Thank you for joining this enlightening journey with David Morgan into unconventional market dynamics. Remember, challenging norms often unveils new possibilities. Stay tuned for more insightful discussions. Don't miss out on seizing opportunities in the evolving market landscape. Subscribe for future updates and be part of the ongoing conversation. Until next time, trade wisely and stay informed. Thanks again.